Hey everyone, John Henry here, slingshotfutures.com. Welcome back. Today we're going to be talking about market timing. Now, market timing is one of those things that a lot of people talk about, but really don't go into detail. And it's probably one of the best things that can help you in turning a good trade into, well, a better trade, or a bad trade into a better trade. It really doesn't hurt anything. Market timing is one of those things that really, it's one of the most important aspects on trading, but nobody really covers it that much. So what do I mean by market timing? Well, first off, we need to find a location of interest, right? So here I have a 60-minute chart of the dollar Swiss, and we'll just go backward a little bit here so we can see some other areas of interest. So pretty obviously, we have a breakdown point, right? I don't think that really needs to be said. We've got a very, very obvious breakdown point. And typically, when previous support is broken, it usually acts as resistance. And once the market begins coming back to that area, that's where we really want to start picking up on market timing. Because as we all know, we've all been there, right? I'm waiting for this level, I'm waiting for this level, and then it never happens and falls apart without you, and you just watch it go after you've been waiting for it to jump in, and it missed you. Because you're waiting for a specific line in the sand. Really what it comes down to is zooming into faster time frames, right? We're deriving our major areas of interest, whether it's a swing high, swing low, a Fibonacci, a harmonic, whatever you care to trade. Really what we're looking for is zooming in once we have that major structural area of interest and going in and saying, okay, I know where I want to begin looking for trades. How do I find them now? Right, so this area right there at those lows is going to be the zone of interest. And realistically, if we look backward a little bit, we can also see that the first time the market bounced after that drop was right there. That creates kind of a zone, right? So we've got a little bit of a zone to work with right inside there, and then we can circle it. And we're going to go to a faster time frame. Now, right now, we're looking at a 60-minute chart, but what we want to do is zoom in even closer. We'll start off with a 15-minute chart and kind of work our way in to give us an idea of what we're looking at. Right, so the market comes up in, and it gives us a beautiful example of that, of what we're looking for. And what we're looking for is a shift, right? A change in who actually owns the markets, right? The buyers have owned the market since these lows. Big, strong rally, big, strong rally, big, strong rally. We can't just go selling randomly into that. We need to know where to get in at the opportune moment. And how do we do that? Well, that's where we zoom in even closer to something like maybe even a 1-minute chart, and really zoom out and look for a market structural area of interest. Let's go back a little bit here. Zoom out real far. There we go. So what are we looking for? Well, first off, you need to understand how the markets work, right? Markets operate in an accumulation distribution phase, right? So you've got accumulation, where the market's just kind of going back and forth, back and forth, back and forth, and then they break out. Now, this area here is what I like calling a decision point. A decision is being made inside of here. While we're inside of that range, we don't know which way it's going to go. Could be up, could be down, whatever. But all we know is that a market is making a decision. This is the decision conclusion, right? The decision has been made, and the market is breaking out. But what happens as we climb up further? The exact same thing happens. The market cycles, and we go back into a decision point. Now, keep in mind, I'm drawing these decision points really wide, but it could be a matter of 2 candles. Either way, there's usually some form of congestion, and then from there, either continuation or it falls apart. And then the same thing happens again. It goes into a range, figures out what it wants to do. So what are we looking to do? Well, if we're approaching a major area of interest and I want to get into the market, I'm not just going to sell while the market's ripping higher like that. That's a really bad place. That's bad timing. Because inevitably, and we've all been here too, you're going to sell here and the market goes flying further up and just rips your face off. When if you would have just stayed patient, you would have had plenty of opportunities in here. So knowing how the market cycles, what we can do is utilize that to our advantage. We want to go into the market and look for when the buying pressure stops, right? Now, it doesn't have to stop on a dime. In this case, it did turn off very quickly. But we have that aggressive rotation to the upside. They pull back. Now we have a lower high into a lower low. This is where a lot of traders are going to try to sell. Well, unfortunately, that's a horrible spot to sell because we haven't had that full transition. Remember, a transitional range does this and then makes a decision. So what does that tell us? Well, if I'm a seller, I want to sell up here. If I'm a buyer, I want to be buying down here. You want to be buying in the bottom third or selling in the top third of that range, preferably even higher, to really give yourself the benefit of the doubt that if you are right and the market does cycle off of that, then you've got a lot of icing on the cake, right? That was a really good trade. And if you're wrong, the beautiful thing about selling high in a range like that is because if you're wrong, you don't really have to risk that much, right? It's pretty obvious when you're wrong. The market goes above and gives you a chance to potentially get out and just take the loss while it's still small, rather than selling down here, because guess what? Your stop still has to go up here. You're reducing your risk by timing your entries a little bit better. So what are we waiting for? Well, we're waiting for that transitional phase. We want that decision point to start forming. Very strong rally to the upside, lower high, lower low. Okay, well, that's the first time we've had a transition like that since the rally up. This is the first time that we've had a lower high and a lower low that really kind of stuck around. So when the market comes flying back up here again, like we saw before, I don't want to be the first one to the party. That's a terrible spot to be. But we do know that this is one of the largest moves that the sellers have had down since the inception of this bullish trend. So we know that something has changed, right? The buyers have lost their grip, maybe a little bit. Doesn't mean the buyers are done, but what it does mean is that we're starting to see a little bit of a kink in the armor, right? There's something wrong with the buyer's case now. They shouldn't be pulling back this far. That tells us that the trend is likely nearing its end. Doesn't mean that it's done, but it does mean that it's getting closer. So what are we looking to do? Well, I'm not selling down here. We already talked about that. It's a horrible spot. We have a strong rally to the upside. I don't want to be selling into that either. But what I do want to sell into is when the market pulls back, tries going up, makes a lower high, and then begins turning back down again, even if it's down here, that is a much better place to begin selling. And the reason for that is because I can sell here and my risk is going to be up here, right? It's a relatively small stop compared to the fact that, remember, this is a 60-minute chart zone of interest. So my risk is this, but my reward is potentially way down here. The risk reward is so far in my favor, it's ridiculous. That's all about the market timing. I'm not selling here while it's rallying higher because, well, that would have meant that I probably would have sold there or sold here and it would have been underwater the whole way. What I want to do is wait for the sellers to actually show they're interested. And once we have that zone of interest, now we have something to work with. Now, let's say you wanted to wait even more, right? There's nothing wrong with that. You have a nice strong leg to the downside. They try going up. We have a higher high trap that starts breaking down. Sellers will flood into that. But it happened very fast. And whenever you have that type of situation, a lot of sellers will have missed the move. They didn't get what they wanted to, or maybe they were looking to sell the high and it fell short. Surprise, surprise, right? That's like we were talking about earlier, where sometimes it just doesn't make it to the area that you want. But when the market comes back up again, guess who's going to be interested, right? Lower high, lower high, lower high, breakdown point, there's your short. And your risk, although is not as good because you're selling a lot further in the range, still looking at it from a probability standpoint, your risk reward, your reward is still much greater than how much you're risking on the trade. So it's a great way to time your entries just by waiting for that decision point transitional phase to begin and then attempting to sell at the high of it or at the low of it so that you can bring down your risk, time your entries a little bit better. And even if you are wrong and the market doesn't collapse like it did here, you still have the ability to profit on these downswings depending on if you're trading multiple contracts or shares or whatever your thing is. So it's a really, really good way to be timing your entries and looking for the best, highest probability zones of interest. It does require a little bit of practice though, because typically you're going to be selling into strength while the market's ripping higher. And well, you've got to have a little bit of fortitude to be able to sell into that as long as you know what you're doing in those areas and you're waiting for the appropriate locations like here. Everything fits along with what you need, but it's all about that market timing. So hopefully you found this video useful, something you can add to your trading tool belt if you haven't already, or if you're just blindly selling, you might maybe want to reconsider and look for some transitional phases instead. Either way though, if you have any questions about it, feel free to shoot me an email, jbrink@slingshotfutures.com. Hope you enjoyed the video. I hope you had a great day of trading, and until the next video, have a good one. Thanks.